So here's the thing, whether you've been at this options trading thing a while or you're just fresh off the theta boat, the spread strategy I'm about to outline will unquestionably increase the likelihood of money entering your pockets and require little to no effort so you can sit on the beach, work your boring engineering job, or stare at the charts pretending like you know what the fuck is going on, all while the money quietly pours in. And no, you don't need some strict set of rules, indicators, or
whatever excuses that you make for why your trades do or don't work.
You simply need to create watch lists, monitor the market for 5 minutes a day, and strike with the weapon I am about to provide you when the opportunity arises. Now, if you're just getting into options and you've dabbled in some tasty trade videos, there's a ton of jargon out there that gets thrown at you about implied volatility, delta, leg width, blah, blah, blah. But in this video, I'm breaking it down so clearly that even a meme stock trader could understand it. I'll even bet you the $2 million that I made in profit from these strategies last year that the sauce I'm about to provide you will, like magic, result in an extra $2K a month per profit in your account within the next 30 to 60 days. And guys, come on, $2K a month profit is literally possible on any account size. It's only 4 trades per month at 500 profit each, and it isn't that hard to find 4 of the setups per month that I'm about to explain once you understand how to do it. Now, if you still don't believe me that these strategies work or the one I'm about to outline works, I'm gonna refresh my account right here on screen and pop up the spreadsheet where I tracked literally every single trade I took in 2024, hundreds of them using theta and advanced option strategies that I'm about to talk about. I'll pop it up for you guys right here, and if you want to download it and look through it like a total nerd, it's going to be in the description. So now that I've semi-qualified myself to speak on this topic, let me try to show you how this spread strategy can absolutely print money for you too, so you can escape the depravity of gambling options and join Option Lab, my community that's filled with people like this who are actually making thousands a month from 70% plus probability option strategies I'm about to discuss. Or if you'd like me to just indoctrinate you into the world of option selling in a 15-minute strategy call, you can book one down below with me directly. I'll do a full dissection of your shitty account and show you how we can make it better. Anyway, let's get into the video. All right, so typically the strategies that I'm talking about are net credit or theta strategies or whatever you want to call them, but this is actually going to be a debit strategy, and one I'm calling, for the sake of this video, the buy the dip debit spread. I'm going to show you guys what it is, how to calculate the max profit and loss, and then steps on how to find stocks that fit the criteria of the strategy. And hopefully by the end of this video, you'll feel confident both finding one of these plays and entering it yourself. So let's get into it. So the first thing that we want to talk about are the basics of a debit spread, a vertical debit spread, so you guys kind of know how to calculate max profit, max loss, and what that would look like on a chart. So in this, I'm going to make it super simple. I drew out this chart here. We're just going to pretend it's AMD, and we're going to pretend that AMD right here is trading around 99. So you can see here, the stock kind of plummeted down and it's currently trading at 99. And we're going to bet on a bullish move, right? So this dotted line is our prediction of where the stock is going to go in, say, 2-3 weeks. So what we would do in order to execute a vertical spread that's bullish, that's a debit spread, we would do what's called a vertical call debit spread or a bull call spread. Now, a bull call spread would look something like this, where we buy +1 of the 100 call, and then we sell 1 of the 105 call. And notice for buying the closer to the money call, we have to pay a debit for doing so. And then to sell to open the further out of the money call, we actually receive a net credit because we're selling to open that option. So this creates what's called a vertical spread, and the max profit is as follows. The max profit we can calculate by doing the width of the strikes, which is 105 minus 100, that's 5, and then subtracting off the net premium paid. So the net premium we paid is we paid out 300, but we got 150 back for this short leg, and we netted out 1.5. So if you take the 5, which is the width of the strikes, minus the net premium paid, we get a max profit of $350, which will be realized if this stock by expiration closes above our short call, which is in this case 105. So as long as the stock goes above our short call strike by expiration, we realize a max profit of $350. The max loss then can be calculated as the net premium paid, which in this case we just calculated is $300, which was how much we paid out to buy that long call, and then the minus the credit we received for selling to open the 105 call. So the net premium then is $150, which means we have a pretty good limited risk, limited reward trade here with a max profit of $350 and a max loss of $150. Okay, so the steps in actually entering and finding this trade. And I mean, this was really just the basics of what a call debit spread is, but in this, we're gonna actually talk about how to find ones that fit this specific strategy. So buy the dip debit spread is essentially this: finding stocks that are very beaten down and then slowly averaging in with call debit spreads at various different expirations, predicting a bounce to the upside or recovery move. So the first step is we're gonna monitor for upcoming earnings reports or large percentage movers. This is gonna give us stocks that are either predicted to go way down or stocks that due to news have already crashed. We're gonna choose a stock from that list that we would like long-term or that we believe will bounce or have a recovery move. We're then gonna enter bull call spreads on large down moves. So in this case, we have a stock here. This is where it's going. And what we're gonna do is essentially enter in with various position sizes at the different entry points. So on the first big drop here on entry 1, we would enter in at about 20% capacity at 3 contracts. So in this case, we have our first down move, and that would trigger me to enter 3 contracts and use the longest expiration. The reason is because if this continues to drop, the longer expiration gives us more time for that stock to recover to where it was prior. Then if the stock keeps dropping after we enter that, then we can size in even further with about 6 contracts, and we're gonna use a medium expiration. So, say if this one was 3 months out, we might do this one as 1 or 2 months out. And that gives us, since it's already now down even lower, it's likely that there's not much more downside before this thing starts to bounce up. So we're gonna add in with a little more size, anticipating that a bounce is coming. Entry 3 then would be if the stock really keeps dropping, and then we're gonna size in even heavier and use the shortest expiration, even betting more that this is the bottom and it's gonna bounce back up. Now, of course, you're saying to yourself, well, what is the downside of this strategy? Well, the downside of the strategy is that if this stock continues to go down and down and down and down, and it stays down, all 3 of these will then be worthless, which is the risk. But in the case of this, you're choosing a stock that you like long-term, that you believe will have a recovery move, and you're sizing in accordingly based on how much that stock has dropped. So in this case here, let's say you have entry 3 here is 12 contracts. The money that you're gonna make just on those, even if it doesn't go back up to a profitable range to make this first entry profitable, the amount you'll make on entry 2 and entry 3 can theoretically recover the shittier entries you had earlier on. So step 4 here is going to be starting small with longer expirations, right? Because it's going to take theoretically longer for that stock to bounce back to this strike price that we first entered. And lastly, we're going to add size and shorten the expiration if the drop continues, which is what I outlined here, right? And the theory here, which can be summarized in this quote: the more it drops, the less likely it is to keep dropping. And this, of course, can be faulty logic, and I have been burned on this strategy before, but generally speaking, I find it is a good way to buy the dip without having to, put out a ton of buying power for just buying options or, using credit spreads. This is a little bit more lucrative if you want to use a debit spread. So that's basically If we want to summarize, we enter into call debit spreads off drops and then add in size if that stock continues dropping. And as we add size, we shorten the expiration in each successive entry. So if you did find that video useful and you do want to download my option selling cheat sheet, click the link in the description. If you want to book a 15-minute call where I dissect your account, you can do that as well. And I will see you guys in the next one. Peace.